International markets have given U.S. a run for its money lately. And for the first time in years, those reasons may actually stick. So the real question is this a short-term rotation or a longer-term trend? Hi, I'm Kara Murphy, and this is Money with Murphy. After 15 years of U.S. domination, the case for international exposure may be strengthening. Last year, that domination was tested as international markets surged. In fact, in 2025, both the MSCI Emerging Markets Index and the MSCI Developed ex-US Index rose by more than 30%. That was well above a still strong 17% rise in the S&P 500. That outperformance came despite the introduction of US tariffs. And in fact, so far this year, emerging markets are again outperforming, even as geopolitical risks remain elevated. So it's fair for investors to ask, will international markets continue to lead from here? There are really three reasons for the recent shift and why it may continue. First, earnings. Importantly, international outperformance hasn't been driven by price alone. Earnings growth outside the U.S. is in fact accelerating, particularly in emerging markets where profit growth expectations exceed those in the S&P 500. In Europe, profits are expected to shift from flat growth last year to solid double-digit gains this year. So here's the key point. Markets follow earnings, and right now earnings momentum is not limited to just U.S. companies. Second, currency trends add to that backdrop. After years of strength, the U.S. dollar weakened last year. And as the U.S. dollar declines in value, assets that are priced in other currencies, such as European stocks, increase in value. As such, a flat or declining U.S. dollar could remove a key headwind for international equities. Third, valuations reinforce the picture. International markets trade at meaningful discounts to the U.S. And as of the end of the first quarter of 2026, the S&P 500 traded at more than 20 times forward earnings. That's 18% higher than its 20-year average and well above valuation levels in both developed and emerging markets. International markets can stay cheap for an extended period of time. And in fact, that's exactly what's happened over the last decade or so. Valuations alone aren't a catalyst, but when you pair valuations with accelerating earnings, the story can change. So if you've ignored international for the past decade, that might have been the right call. The question now is whether that call needs to change. Even beyond near-term fundamentals, international markets can be a helpful buffer against challenges in the U.S. For instance, U.S. markets have become increasingly concentrated, particularly as the artificial intelligence boom have driven gains in a narrow group of stocks. Nearly half of the S&P 500 is now concentrated in just two sectors, technology and communication services. That's a very different market than when many investors think they own. International markets offer exposure to different economic cycles, growth drivers, and policies. In fact, in contrast to the U.S. exposure, the MSCI All-Country World ex-US Index is heavily weighted to financials and industrials. I mentioned earlier that U.S. stocks have led for roughly 15 years. Step back further, and that leadership looks far less permanent. Here's the part investors tend to forget. Since the 1950s, U.S. markets have only outperformed in about half of all of those decades. Leadership rotates, and often you don't realize it until it's already happening. With earnings accelerating abroad, valuations still favorable, and leadership becoming more dispersed, international markets deserve a seat at the table. Not as a replacement for U.S. exposure, but a complement. Invest wisely and live richly.